Consideration of Chapter 5, Practice Management. Answer to example on accepting a new audit appointment. Answer: the following matters may be considered. 1. Reputation. The audit firm may decide that it does not wish to be associated with a client company whose public relations image is poor. The bad reputation of the company may transfer to its auditors. 2. Advocacy threat. The criminal or regulatory investigation may lead to legal action, and the audit firm may be faced with an advocacy threat and be expected to defend the company against the allegations that have been made against it. 3. Aggressive management. Backhoe Company has aggressive managers who are willing to argue with auditors and who want to keep costs as low as possible. There is a high risk of continuing disputes over audit fees. 4. Audit risk. If the company applies for new bank loans, it will probably be required to submit audited financial statements to the bank as part of the loan application. The management of Backhoe have a strong interest in presenting financial statements that show strong profit and a healthy statement of financial position. The risk that the financial statement may be misstated could therefore be high. The audit firm would probably wish to consider including a disclaimer in their audit report to reduce the risk of liability to a bank for negligent auditing in the event that the financial statement turns out to be misstated and the errors are not identified by the auditors. 5. High audit risk is also suggested by the weak internal control and failure by management to improve controls. 6. The high audit risk means that a new auditor would want to conduct a very careful audit of the opening balances. This would add to the cost and time required for the audit, which Backhoe management may refuse to accept. However, there is no evidence of fraud or suggestion of fraud by anyone in the company, and the audit firm may decide to accept the audit appointment subject to agreement about fees. Acceptance of a new audit client is a matter of judgment. Section 2.4. Books, Documents and Records. Client books and records. Right of lien. Once a new auditor has been appointed, the outgoing auditor should arrange for the transfer of any books and records belonging to the client that are in his possession. However, where fees remain unpaid, the outgoing auditor may wish to exercise a legal right of lien over those client books and records. 1. A lien is a right to retain possession of property belonging to another until amounts due are paid. 2. Auditors have a particular as opposed to a general lien. This means that the right of lien is only in respect of those books and records on which the auditor has performed audit work. In other words, for the lien to be applied, the document must have come into the auditor's possession lawfully, and an invoice must have been sent to the client company for the fees owing, and there must be no dispute over fees. Unfortunately, in some countries, legal decisions have been taken that mean a lien cannot be exercised over books and records which the client is required to keep by law. In many cases, this legal requirement applies to most of the client's books and records. Consequently, these legal decisions may significantly reduce the effectiveness of the right of lien. Auditor working papers. Audit working papers are documents prepared by the auditors for the purpose of carrying out their audit work. In general, this belongs to the auditor. unless there is a provision to the contrary in the engagement letter or in national law. However, the outgoing auditor will be expected to provide the proposed new auditor with information that is sufficient for a reasonable handover of audit responsibilities. The precise nature of this information will depend on the stage that the audit has reached when the responsibility for the audit passes from the old audit firm to the new one. Subtopic 3. Obtaining and charging for professional work. Section 3.1. Obtaining professional work. Audit practices will want to increase the size of their client base. Audit practices will want to increase the size of their client base as a means of increasing the profit of the practice. This can be achieved by promoting their good reputation in the business community, recommendations from existing clients, advertising, publicity and promotion such as sponsorship activities. Section 3.2. Advertising and publicity. When a professional accountant in public practice solicits new work through advertising or other forms of marketing, there may be a threat to compliance with the fundamental ethical principles. For example, a self-interest threat to compliance with the principle of professional behavior is created if services, achievements, or products are marketed in a way that is inconsistent with that principle. Advertising and publicity activities by accountancy firms are therefore regulated by IFAC and ICAN through their codes of ethics and conduct respectively. Note that ICAN has adopted all of IFAC's guidance in this matter. The main requirements for marketing professional services are that the advertising and publicity material used by any firm must not bring into disrepute the professional body, the firm, or the profession as a whole, should not make exaggerated claims for services offered, qualifications possessed, or experience gained. It should be honest and truthful and not mislead. Must not discredit the services provided by other firms or make disparaging references to unsubstantiated comparisons to the work of another chartered accountant. Must not break any local recognized codes of advertising practice. In addition, it is recommended that advertising and publicity material should avoid any reference to fees. If fees are mentioned, there should be a statement of the basis on which the fees are to be charged. Comment about fees must not be misleading, must not offer discounts, and must not make comparison with the fees of other service providers. ICAN's Professional Code of Conduct and Guide for members states that if a chartered accountant in public practice is in doubt whether a proposed form of advertising or marketing is appropriate, they should consult through the registrar or chief executive of ICAN. Section 3.3. Fees. General approach. The question of setting a price for the provision of a service is always a sensitive matter because of disputes that may arise if the fees are unreasonable. In establishing the fee for professional work, the accountant should follow professional guidance. In any case, they must ensure they do not breach any of the fundamental ethical principles. For example, a self-interest threat to professional competence and due care may be created if the fee quoted is so low that it may be difficult to perform the engagement in accordance with applicable technical and professional standards for that price. Safeguards against threats may include 1. Making the client aware of the terms of the engagement and in particular the basis on which fees are charged and which services are covered by the quoted fee through the engagement letter. And 2. Assigning appropriate time and qualified staff to the task. ICAN's Code of Conduct states that a member is entitled to charge for his services. Where the basis of a fee has not been has not specifically been agreed, then a member should charge a fee which is fair and reasonable, taking into account the seniority and professional expertise of the person necessarily engaged in the work, the time expended by each, the degree of risk and responsibility which the work entails, the priority and importance of the work to the client, together with any expenses properly incurred. Firms should then charge the client the fee that they have quoted or the tender that the client has accepted, unless extra work is required. If extra work is required that was not expected when the original fee was agreed, the firm must provide an explanation to justify the higher fee. Other ICAN Code of Conduct Guidelines. ICAN's Code of Conduct provides further specific guidance regarding fees as follows. 1. ICAN advises minimum charge out rate in respect of fees for professional services, which are intended to set a benchmark below which members are not ordinarily expected to charge. 2. A member should inform a client in writing prior to commencement of any engagement the basis upon which any fee he proposes to charge for his services will be calculated, and on request and where practicable, the level of fees likely to be charged for any assignment. 3. The member should discuss and explain the basis on which fees will be calculated, including the estimated initial fee, at the earliest opportunity. This discussion should be confirmed in writing, normally in an engagement letter. 4. Firms should not quote a level of fees for new audit work which is lower than that charged by an existing auditor. Firms should also not quote by tender a level of fees which they have reason to believe is significantly lower than those quoted by other tendering firms. In both instances, the firm's objectivity could be threatened. 5. When performing audit work, firms should ensure that their work complies with auditing standards and guidelines, and in particular, quality control procedures. In the event of a complaint being made by the institute, which might have arisen as a result of a professional practice monitoring committee's inspection, where fees were a feature in obtaining or retaining the work, firms should be prepared to demonstrate that the work done was in accordance with auditing standards and the client was not misled as to the basis on which fees for the current and subsequent years were to be determined. 6. A member whose fees have not been paid may be entitled to retain certain books and papers of a client upon which he has been working by exercising a lien, and may refuse to pass on information to the client or his successor chartered accountant until those fees are paid. However, a member who so acts should be prepared to take reasonable steps to resolve any dispute relating to the amount of that fee. The incoming auditor has a duty to assist in the recovery of such fees within a reasonable time. 7. Fees should generally not be based on a percentage or on contingency calculations for audit work, reporting assignments, and similar non-audit rules. Companies and Allied Matters Act, CAMA. Section 361 of CAMA provides that the remuneration of auditors may be fixed by the directors if the auditors are appointed by the directors. However, in other cases, the auditor's remuneration shall be fixed by the company at the annual general meeting or in such manner as the company in general meeting may determine. Remuneration in this context consists of auditors' fees and expenses. Section 3.4 Tendering. Introduction. Tendering is a commercial process widely used by companies, especially larger companies, when they wish to change auditors. Tendering involves two or more audit firms being invited by a company to submit a proposal for its audit work. The invitation may or may not include the existing auditor. This section describes the commercial tender process used by companies to select new auditors. Section 2 above addresses the specific legal and ethical mechanisms associated with actually changing the auditor in Nigeria. Initial considerations. Tendering should commence only when a firm has been approached by a prospective client. In any case, a firm should not submit a tender for the work unless it can give satisfactory answers to the following questions. 1. Does the firm have the expertise to carry out this audit? 2. Does the firm have or could it have sufficient staff available at the appropriate time? 3. Are there any ethical reasons why the firm could not act? For example, a problem with independence or a conflict of interest. 4. Are there any problems of which the firm is aware with the current audit or auditors? Specifically in relation to a tender, the firm should also ask itself, 1. Why has it been asked to tender? 2. Could it and should it offer to do the audit for a lower fee than other firms are likely to quote? 3. Are there any reasons why this audit is particularly attractive to the firm? For example, will the work be carried out at a quiet time of year, or is the company in an industry area where the firm wishes to develop its audit experience and expertise? 4. What audit risk might arise with this particular client? The tendering process. The principal benefit to the client of a tendering process should be lower audit fees because several firms are competing for the work. In response to the pressure to reduce their fees, audit firms have become more efficient and lowered their costs. Even so, the tendering process can still be high risk for a firm. For example, the firm needs to be confident that the client is one that it can deal with professionally and economically if the tender is accepted. If the tender is not accepted, the time and cost involved in the tendering process, which may be considered, has been wasted. The firm needs to be sure that a sufficiently high proportion of its tenders will be successful to justify the cost. The tendering process should be broken down into the following stages, assuming that a firm is submitting a tender for the audit of a new client. 1. Collect background information about the possible new client. This is necessary when evaluating any new client, whether the fee is to be set by tender or by any other method. 2. Establish the precise scope of the work to be performed and the specific requirements of the prospective client. 3. Carry out a preliminary audit risk assessment and prepare a preliminary plan for the audit. The plan must cover the staffing requirements and the time requirement for the work. 4. Estimate a fee. 5. Prepare a submission document for the potential client. The content of this document will typically include an outline of the key characteristics of the firm, clarification of the nature of the audit work or other non-audit work to be performed, a statement of the requirements of the client and how the firm will comply with them, an outline of how the work will be performed, the proposed fee and the basis of its calculation, the range of other services which the firm would offer to the client. 6. If required, prepare and give a presentation to the potential client. Evaluating the tender. In evaluating the tender, the client or company is likely to consider the following issues. 1. Fees. 2. The services that the firm is able to provide. 3. Geographical locations and coverage of the firm's office. 4. Expertise of the firm and its staff. 5. Reputation of the firm. 6. Whether the senior management of the company think that they will be able to work well on a personal level with the potential engagement partner and key audit staff. 7. The formal presentation itself by the audit firm. 8. The extent to which the company wants to change its audit firm and its dissatisfaction with the current audit firm. Lowballing. Lowballing is the practice of tendering for the audit work at a very low fee with the objective of winning the audit. If it is successful in obtaining the audit, the firm will hope that it will be able to raise the audit fee in future years, or it will be able to recover losses on the audit fee by providing other more lucrative non-audit services. Although there is no evidence that lowballing leads to a poor quality audit, the fact that it exists does nothing to improve the reputation of the auditing profession. The existence of low fees may suggest to the business community and to the general public that audit work is of a low quality. All fees should be sufficiently adequate to compensate a firm for the work that it carries out. Section 3.5. Credit control within an audit firm. An audit firm does not just charge fees. It has to collect the fees that it charges. A failure to invoice clients promptly or a failure to collect payment within a reasonable time after the invoice date would be an indication of poor credit management. Any such management weaknesses should be corrected if they occur. Occasionally, non-payment of fees may be due to the fact that the audit client is in financial difficulties and cannot pay. Overdue fees are a threat to the independence and objectivity of the auditor, because it might be argued that audit work has been provided free of charge. If the unpaid amount has been overdue for a long time, it could be regarded as a form of loan by the audit firm to the client. The risk to auditor independence could be significant if the unpaid amount is material. When a client is in temporary financial difficulties, it is permissible for an auditor to make commercial arrangements for staged payment of the fees due. The client should be made aware, however, of the ethical problems that non-payment or late payments create for the audit firm. For future audits, if the audit engagement is retained, the auditor should pay particular attention to the going concern assumption. If the client still has continuing cash flow problems, the going concern assumption may be challenged. When unpaid fees are owed by a client and the period of late payment is in excess of what might be regarded as commercially acceptable, The audit firm should consider whether it would be ethically appropriate to resign as auditors. The ethics partner of the firm should be asked to assess the ethical threat to the firm's independence and integrity. If the decision is to continue as auditors of the client, the reason should be documented. The most recent audit papers should be checked to ensure that sufficient appropriate evidence was obtained to support the going concern assumption in the financial statements. Subtopic 4. Agreeing the terms of audit engagement. ISA 210. Section 4.1. The objective of the engagement letter. The objective of the auditor per ISA 210, agreeing the terms of audit engagement, is accept or continue an audit engagement only when the basis upon which it is to be performed has been agreed. This is done by 1. Establishing whether the preconditions for an audit are present, and 2. Confirming that there is a common understanding between the auditor and management. To establish if the preconditions of an audit are present, ISA 210 requires the auditor to 1. Establish if the financial reporting framework to be used in the preparation of the financial statement is acceptable. 2. Obtain the agreement of management that it acknowledges and understands its responsibility for the preparation of the financial statement, for internal controls to ensure that the financial statements are not materially misstated, to provide the auditors with all relevant and requested information, and unrestricted access to all personnel. The auditor is required to refuse the engagement where 1. A limitation on scope is imposed by management such that the auditor would be unable to express an opinion on a financial statement, or 2. The financial reporting framework to be used in the preparation of the financial statements are unacceptable, or 3. Management do not agree to the above responsibilities. Section 4.3. The content of the engagement letter. The engagement letter must include reference to the following: 1. The objective and scope of the audit. 2. The responsibilities of the auditor. 3. The responsibilities of management. 4. Identification of the underlying financial reporting framework. 5. Reference to the expected form and content of any reports to be issued. Because it specifies what the auditor will be doing and what the auditor's exact responsibilities will be, the engagement letter is also seen to be an important way of reducing the expectation gap. This is the difference between 1. The view of the role and responsibility of the auditors that is held by the users of financial statements, and 2. The auditor's actual, that is statutory, role and responsibilities. In addition to the above, the auditor may feel that it is appropriate to include additional points in the engagement letter, such as 1. Regulations, ISAs, and ethical pronouncements. 2. The fact that because of the inherent limitation of an audit and the inherent limitation of internal control, there is an unavoidable risk that some material misstatement may not be detected even though the audit was properly planned and performed in accordance with ISAs. 3. Arrangements regarding the planning and performance of the audit, including the composition of the audit team. 4. The expectation that management will provide written representations. 5. The basis on which fees are computed and any bidding arrangements. 6. A request for management to acknowledge receipt of the engagement letter and to agree to its terms. 7. Arrangements concerning the involvement of other auditors. Arrangements concerning the involvement of other auditors, experts, or internal auditors, or other staff of the entity. 7. Any restriction of the auditor's liability when such possibility exists. Best practice also recommends that the engagement letter should include an explanation of the auditor's responsibility with regard to anti-money laundering checks and procedures. Section 4.3. Annual review of the engagement letter. The engagement letter that is issued on the initial appointment of the firm as auditors may specify that its provision will apply to all future audits until it is revised. However, ISA 210 requires the auditor for recurring audits to assess whether circumstances mean that the terms of engagement need to be revised. Management needs to be reminded of the existing terms of the engagement. The ISA suggests that the following factors may indicate that the above is appropriate. 1. Any indication that the entity misunderstands the objective and scope of the audit. 2. Any revised or special terms of the audit engagement. 3. A recent change of senior management. 4. A significant change in ownership. 5. A significant change in nature of or size of the entity's business. 6. A change in legal or regulatory requirements. 7. A change in the financial reporting framework adopted in the preparation of the financial statements. 8. A change in other reporting requirements. Section 4.4. Acceptance of a change in the terms of the engagement. The entity might, in certain circumstances, ask the auditor to change the terms of the audit engagement. This might result from a genuine change in circumstances or from a misunderstanding as to the nature of an audit as originally requested. However, it could result from a situation where the auditor is unable to obtain sufficient appropriate audit evidence regarding a material item. The entity might then ask for the audit engagement to be changed to a review engagement to avoid a qualified opinion or a disclaimer of opinion. ISA 210 requires the auditor to consider the justification for the request and whether it is reasonable. If the auditor considers that it is a reasonable request, then revised terms should be agreed and recorded. If the auditor is unable to agree to a change of terms, he should withdraw from the engagement and consider whether there is any obligation to report the circumstances to those charged with governance, owners, or regulators. Subtopic 5. Chapter Review. Before moving on to the next chapter, check that you now know how to describe the components of a system of quality control applied to a firm of accountants performing audit and assurance engagements, to explain the process around changes in professional appointments, including legal, commercial, and ethical considerations. 3. Apply ISA 210 in agreeing the terms of an engagement. Quick quiz questions. 1. According to ISA 220, who should have the responsibility for key quality control matters and for the overall quality of the audit? A. The senior partner of the audit firm. B. The board of directors of the client company. C. The engagement partner. D. The entire audit team. Answer is C. The engagement partner. Question 2. Which of the following items does a letter of engagement normally include? 1. Statement of the auditor's duty to prepare the financial statements. 2. Basis of fees. 3. Auditor's unrestricted access to documents and records. 4. Provision of a letter of weakness, that is, management letter. Options: A. 1, 2, and 3 only. B. 1, 3, and 4 only. C. 2, 3, and 4 only. D. 1, 2, and 4 only. The answer is C. It is management's duty to prepare the financial statement, not the auditors. Question 3. Quality control procedures for specific audit engagements may be applied by means of: A. Training of audit staff. B. Supervision of audit staff. C. Compliance with IFAC ethical rules. D. Monitoring the independence of audit staff. The answer is B. Supervision of audit staff. Quality control procedures specific to individual audit engagement involves the direction and supervision of staff and review of their work. Question 4. Client screening before accepting a new audit appointment involves: A. Checking whether the firm has sufficient technical expertise to do the work. B. Checking whether a conflict of interest may exist. C. Taking up reference for the company and its directors if these are not known to the firm. D. Communicating with the previous auditors about the circumstances leading to the change of auditor. The answer is C. Before agreeing to accept a new audit engagement, the audit firm should consider several issues, including conflict of interest and technical capacity to do the work. However, client screening is specifically checking the references provided by the company and its directors when these are not known to the audit firm. Question 5. A rule of an audit by the engagement partner. A review of an audit by the engagement partner should be carried out: A. After the audit report is signed and after a similar review by the audit senior. B. After the audit report is signed and before a similar review by the audit senior. C. After a similar review by the audit senior but before the audit report is signed. D. Before a similar review by the audit senior and before the audit report is signed. The answer to question 5 is C. The review by the audit engagement partner takes place towards the end of the audit, before the audit report is signed. Usually, the audit senior carries out a similar review before the review by the engagement partner in an attempt to anticipate issues that the engagement partner might raise. That's the end of chapter 5. Thank you.